A lot of people are seeing and feeling the change in the cycle.
Yes.
And we have been hearing things like news, indications, but when you're in these periods of economic changes, both short-term cycles and long-term cycles, there is a lot of confusion. And because we obviously don't know. It's really easy when everybody knows what's happening and see it moving, where interest rates are 3%, jobs are up, income's up, numbers are going, even in down cycles.
Exactly.
It's nope, it's going down. This isn't going to change, right? But it's this weird in between where everybody's waiting. Is it going to go down? Is it going to go up? So where are we at just as a viewpoint in this overall cycle right now?
Sure. It's absolutely an inflection point. And you're right. Those are the most dangerous, but they're also loaded with the most opportunity because
Yes, they are.
When everyone's moving in the same direction, when things are clear, well, you can't really outperform, but now is the time you can be that salmon swimming upstream. You can get ahead of the cycle. It won't feel comfortable because you will be, well, that one salmon swimming upstream. But I think where we are in early 2025 today in real time, this is the point at which the cycle is already showing the fundamental signals are turning up. So various different sectors move through the business cycle, not in perfect lockstep. But if I'm talking about the industrial economy overall, the manufacturing economy, GDP, those big picture items, they were a little bit cooler in 2024. It felt like, if not a down year, at least a flatter year, more subdued growth in something like GDP, even a mild contraction in the industrial and manufacturing economies. So headed into 2025, the good news is our fundamental leading indicators are showing pickup. They're showing signs of life, those green shoots already forming. So I expect this year to be better for most industries. Now, I say most industries because I know you have a lot of listeners today who are in some of those outliers. By that, I mean things like the residential construction market, that tends to move ahead of the cycle. So they're at a different phase, and non-residential construction moves behind the business cycle, which it sounds bad. I don't mean that in a judgmental sense, because it's kind of good to be moving behind the cycle. You have so much more forward-looking visibility. You can see all of these leading indicators with a year, even 2 years of really, really compelling leading evidence. You can absolutely know what's coming next for your business. Now, unfortunately, today, again, in early 2025, most non-res construction is in for a little bit of a cooler year this year. And residential construction, we can certainly talk there. I'm looking for a little bit more subdued growth in that sector.
Okay. And this has been an interesting theme because a lot of our listeners are, even like me and my firm, I own product-based companies, SaaS businesses. The bulk of what I do is in commercial real estate. And a lot of people are dabbling in things. They either have a job, they're trying to invest. I own the stock market. I'm investing in Bitcoin, but I'm also a residential real estate investor, right? So this is an important point that you bring up, that in these cycles, different industries are at different levels. One's behind, one's forward. When you look at, let's say, for example, the residential, this lagging behind of the construction part, that can have a large effect on pricing and home prices, as we saw after 2008. So when we deal with home prices, what is your guys' outlook on that?
So home prices do tend to be a really good store of value. We don't see too many very significant downturns. I know we all lived through 2008, so that's fresh in all of our minds that it can happen. It does happen. I'm not saying it never happens, but this most recent cycle, we saw such a rapid run up in home prices. That is starting to ease off now. I've seen new home prices tick down a bit. Existing home sale prices still seem to have some levity to them. But that is factoring kind of in a circular way back into my forecast for new home starts, because with pricing so elevated and even more importantly with interest rates, mortgage rates so high, that's casting some real affordability concerns over either a first-time home buyer's ability to go out and buy that house, or more importantly on the mortgage rate front, if I'm an existing homeowner with a 3-4% mortgage, man, that is a hard decision to make, to sell that house, get a new mortgage at, 7% today? So we're seeing a real dampening effect of existing home sales. That in turn disincentivizes new home construction. And so I do think we need more houses. We've been underbuilding. Housing starts have not kept pace with household formations, but this affordability is kind of a wet blanket that I expect to continue weighing on new activity.
Now, is that affordability, in your viewpoint, more so a interest rate or a supply issue?
Definitely both, but right now mortgage rates are I'll call it the precipitating factor. So the rapid increase that we saw in the past couple of years in just how quickly mortgage rates ran up, that was the kind of shock. Home prices didn't respond quite that quickly. And like I said, we've been underbuilding, but that is a decade long issue. It wasn't a shock to
Yes.
the system quite so much as interest rates had been.